High Mount Research Market Insights video for October 19th, 2023. Hey everybody, Willie Dowitch here. Glad you have tuned in. Glad you are here. It's time again for another one of our, it used to be weekly. They've been a little less than weekly lately. Midweek 3 for Thursday video updates. Take a look at what's happening in the market. A couple topics that I think are relevant that I think we should be paying attention to. Today for 3 for Thursday, I'll warn you now, we've got 4 charts. Don't think that, my exposure to academia this fall has addled my brain and is keeping me from adding correctly. This is 3 for Thursday, 3 ideas for Thursday. It's just the first one is going to take 2 charts to explain a little bit. The first one, look at this divergence at the sector trend perspective between momentum trends and breadth trends, what that might mean going forward. Look at the earnings revision trend to see how that is rolling over as macro risks start to become a little bit more acute as we go through into the fourth quarter. And then take a look at this idea of new lows and this idea that yes, we've seen fewer stocks making new lows now than we saw this time last year, but we're also seeing fewer stocks trading overall. And so I think what is happening is you're getting the weak stocks are getting delisted, so there's fewer stocks out there to make new lows. But and again, this is a critical point. We continue to see more new lows and new highs. That is a key determinant from my perspective when we think about some of our tactical models. When we talk about breadth, we want to see not just fewer new lows, but what we want to see an expansion in new highs and new highs above new lows. The key takeaway from all this: we've got a market that's churning, is moving largely sideways. The S&P 500 today is testing that 4,300 level again. But if we step back and think about it more broadly, I think we need to remember bull markets don't let you in, bear markets don't let you out. And so we can make the case that this isn't a bull market because we see more stocks making new lows and new highs. I mean, it's not that relentless rise. It's also a little bit difficult to say that this is a classic bear market because it's more of a churning market. So it's a market that's moving sideways. I think the risks are elevated, and so if there's going to be a big move, it's likely lower. But for now, it's a churning market that's frustrating both extreme optimists and extreme pessimists, and basically it's a move to the sidelines kind of market. So that's 3 for Thursday. Let's look at the charts. We begin with our sector level trends indicator. Orange line here, that's momentum trends at the sector level. Surging momentum tends to move early. What we want to see now is whether or not breadth follows. Right now, sector level breadth trends are about as poor as they can be. So we've opened up this wide gap between momentum and breadth. And the question is, so momentum moves first, breadth follows. Seeing this large gap, does that indicate that we're going to basically get a narrowing by breadth following momentum and see the surge improvement? You look at the momentum breadth spread, yes, it's as wide as it's been in years, one of the widest in the past decade. But if you look at other incidences where we've had these large spreads, sometimes it's been at the bottom, like we saw coming off the COVID lows, like we saw in late 2018, like we saw in 2016, but it also occurs during some of these false bounces, these bear market rallies, that we saw along the way in late 2018, that we saw last year. So at this point, yeah, it's interesting to see this wide spread between momentum and breadth, and that can be encouraging. But what's decisive is to see breadth follow momentum higher. So far, we are not seeing that. That's what we want to look for any sort of evidence of sustainability. Right now, it looks like the opposite, actually. Over the last couple of days, it looks like momentum might try to roll back over as breadth remains relatively poor. From an earnings revision trend perspective, we've had our eyes on this for a while. Over the past year, we've had this pattern of higher highs and higher lows. That's encouraging. That's earnings or analysts having to take earnings estimates higher, revise them higher. That's a tailwind for stocks. That now has stopped. Now we see that trend rolling over. Macro risks are on the rise. We talked about this earlier this week, seeing copper drop to a new year-to-date low on a weekly basis. There's complacency on the surface as some data is relatively better than expectations, but I think that veneer is really thin beneath the surface, there's more cause for concern, and seeing this earnings revision trend rollover adds to that concern. So then let's turn to this idea of new lows and new highs, and the relative improvement that we're seeing because we're not seeing this expansive list of new lows that we saw at this point last year. And it's true, we're seeing fewer stocks make new lows now than a year ago. But I believe what's happening is, as we see this trend in the total number of issues traded move lower, what you're seeing is the weak stocks being delisted. They're not trading anymore. You don't delist strong stocks, you delist the weak stocks. And so that makes some sense that the weakest stocks, those making new lows, are getting taken off the exchanges. But here's the critical point. We're still seeing more new lows and new highs. The relationship between new lows and new highs, it's an improvement to see fewer new lows. It's decisive to see new highs greater than new lows. We're not seeing that right now. We've only seen hints of that over the past year. Unless and until that changes, calling this a bull market seems to be premature. And I would side with the overall weight of the evidence that says risks are lower. Yes, we can churn for a while, but if there's going to be a move, it's likely a move to the downside. So that's 3 for Thursday this week, 4 for Thursday if you're counting very closely. Just trying to recap some of what we're seeing. We're seeing a wide spread between momentum and breadth. We need to see breadth follow momentum if the market is going to stage what many are looking for in the fourth quarter in terms of a rally. Working against that, poor breadth, more new lows and new highs, and now the earnings revision trend rolling over. If the earnings revision trend continues to roll over, looking for stocks to move higher into year end is probably folly at this point. That's 3 for Thursday. I'm Willie Delwich. This is High Mount Research. Thanks for tuning in. Thanks for listening, and I'll talk to you again soon.